I published a new post last Tuesday, July 21st, discussing some of my recent trades. A link to my blog post can be found in my profile section here at YouTube. I will be publishing a new post next Tuesday, July 28th. I'm way behind in discussing my trades given the increased volume of them. The primary stock trade discussed in my last post was to sell 100 shares of Power Corporation of Canada on the Toronto Exchange, realizing a gain of 6,776 Canadian dollars. I've traded that stock many times over the years. I am far more interested in harvesting gains in stocks than to continue receiving dividends on the shares sold, given my life expectancy, financial objectives, and financial condition, all of which combine to make current income more important than possible more capital appreciation in a stock position that may evaporate based on later developments. I'm continuing to buy 26-month Treasury bills at the Monday auctions and close to 20 investment-grade corporate bonds each week with a weighted average maturity close to 2 years. I'm increasingly buying more first mortgage bonds issued by operating companies wholly owned by utility holding companies. All of these securities have $1,000 par values and are bought at discounts to par value. I have started to buy a few short-term Treasury notes in the secondary market as yields to maturity creep higher week after week since the war started in late February. I'm buying only in one note lots and have already started to buy one more at the same note at higher YTMs, that's yield to maturity. An example is a purchase of a 4% Treasury note maturing on May 31st, 2028 at a 4.154 YTM on 7/16, and another purchase of one at a 4.361% YTM on July 23rd, which I plan to discuss sometime in August. I will be reducing my Treasury bill purchases after buying 20 of the 6-month Treasury bill at next Monday's auction. The primary reason for buying the 6-month bills throughout July was to shift the tax recognition of interest income into 2027. The interest is taxed in the year the bill matures when held to maturity. The investment rates of those bills that I purchased this month have been close to 4%. That is above the current federal funds range of 3.5 to 3.75%, which indicates that investors believe that the Fed will hike the federal funds rate by at least 0.25%, 25 basis points before the December meeting. The 10-year Treasury yield closed at 3.97% on February 27, 2026, and at 4.69% last Friday. I attribute the increase in interest rates across the maturity spectrum to the inflationary impacts of the Iran war, which shows no signs yet of ending. The issue that needs to be resolved, the short-term issue, I should say, that needs to be resolved now, which was not addressed in the MOU, is administrative control over the Strait of Hormuz and what looks like some kind of revenue sharing agreement between Oman and Iran, which is under discussion now, according to news reports. The resumption of hostilities restarted when Iran attacked ships transiting the southern corridor near Oman's coast rather than the corridor approved by Iran near Iran's coast. I read a report today that those negotiations were making progress. I recall reading articles before the MOU that Iran was negotiating with Oman on this revenue sharing type of agreement. And by revenue sharing, I mean that both countries would impose tolls on cargo passing through the strait, and they will call it something other than a toll, uh, a service fee of some sort. Another contributing factor to higher interest rates are Trump's renewed push to impose more tariff taxes on U.S. importers. The new Republican tariff taxes on U.S. importers will add to inflationary pressures. The latest increase took effect last Friday and applied to products shipped from 60 countries to the U.S. The entirely bogus reason given for those taxes on most of the countries was that those countries, which included Switzerland, the EU countries, the UK, and other Western democracies, uh, were engaging in forced labor practices. It has become crystal clear to all foreign governments and foreign leaders that making concessions for a trade deal with Trump that is signed only causes him to levy more U.S. tariff taxes on U.S. importers that results in lower exports from those foreign countries. Trump also recently started major tariff taxes on products shipped from Canada and Brazil. The one on Brazil was 50% on a number of products. More Republican tariff taxes are coming soon. I noted in a comment to my last blog that margin debt is in a parabolic spike higher and just hit a new record high of 1.5 trillion. While using borrowed money to buy stocks will contribute to price increases as well as short covering, both may accelerate a decline when some external event triggers stock selling that significantly outstrips demand, which has been uh, less robust due to factors relating to valuations. Margin calls go out, forcing stock sales as prices decline, and then short sellers start piling on to the decline by selling stocks they do not own and ETFs as well as futures contracts. Those market dynamics can result in a significant decline even when stocks are not in extreme valuation levels as now, which is the case for the stock indexes presently using traditional valuation metrics. These metrics are not short-term sales signals, but do highlight an increased danger of a major valuation reset, increasing in probability as valuations move into more extreme levels, notwithstanding obvious risk to the optimistic future forecast embedded in current stock prices. And in many of the prices, as far as I'm concerned, their future forecasts are optimistic for over a decade. I will note in my next post also that the stock charts for several market leaders are showing weakness after parabolic spikes higher, rolling over into downtrends after setting new all-time 52-week highs. Maybe they will snap out of the current downtrends, maybe not. I'm not able to predict the future like other investors who actually believe they can. Some stocks and stock sectors, including equity REITs, which I own, have benefited so far by rotation into them, but that may not last for much longer. If an equity REIT stock with a good dividend goes from a $28 stock price to $35 in a few months, that will generally exhaust the uptrend. We're not talking about stocks like NVIDIA. in these kind of sectors. The declines are in major stock sectors that include enterprise software due to concerns about AI taking away their business, semiconductors and memory chips with some exceptions, and has extended into stocks that are making massive investments in AI, and those include Oracle, Meta, Amazon, and Google. I am skeptical that those investments will ever generate an acceptable return on the capital being invested now and in over the next year or two. That spending is providing a significant and temporary lift to U.S. GDP, an artificial one as far as I'm concerned, but the benefits are limited primarily to those supplying products used to build the AI data centers and contractors hired to build them. Almost all American consumers do not benefit from that spending, and the overall impact may be negative for them, and that jobs will be lost due to the development of AI, and electricity bills are skyrocketing as these data hogs require utilities to build new and more expensive power plants to meet the new demand. So this spending is not, in my opinion, benign for the overall U.S. economy. My current conservative investment positioning will benefit from a major stock market decline and a continued rise in interest rates. I've constructed a bond ladder where I have T-bills and corporate bonds maturing each week. A rise in interest rates results in being able to invest the proceeds from maturing bills and bonds into higher yielding ones, thereby generating more interest income for me. I'm not materially adversely impacted by interest rates going up for that reason, and also by the short duration of my bond portfolio and heavy weighting in treasury bills, and the ability to hold everything that I buy to maturity. In other words, no forced selling at an inopportune time. I remain in a risk-off mode, which I can continue for as long as I remain uncomfortable with stocks and my discomfort is increasing rather than abating. Maybe something will happen in the Iran war. There have been no new attacks over the past 2 days, and that may end up being encouraging. This is related, appears to be related, sitting for me sitting at a desk in Tennessee and observing these events, to the issue of administrative control over the strait and revenue sharing between Oman and Iran, which I discussed earlier in the video.